Well, welcome everyone to the April monthly market update from Principal Wealth Partners. I am your host once again, Julina Ogilvie, joined by our founder and CEO, Bob Paolucci. Bob, thanks again for joining me.
Thanks for having me, Julina.
So I think we're going to begin this conversation right where we left off the March discussion, if that's fair to say, and talk about the three hurdles that we need to overcome to achieve the next extended bull market in equities. And we have them listed here, which we're going to talk about today. We're going to spend most of our time on the Federal Reserve, especially given the banking fear and the deposit fear that we have seen recently. Would love to get your thoughts on how that's possibly shifted their position. We're going to talk about earnings, which continue to come out, and then we're going to address really quickly the debt ceiling.
Sounds fair. Yeah, and the slide you have up is, we took last month's three hurdles, the three things that are in the way of a bull market slide, and we made some updates. And you can see the Federal Reserve, right? We went from talking about, how far will they go, when will they pivot, and the market doesn't care. It is pricing in the Fed having to cut this year, and not by a little. The bond market is pricing in the Fed having to cut this year, and not by a little. And we updated the slide to add in the new banking and deposit fears. The Fed, Jerome Powell himself at the last meeting said that further rate hikes may not be warranted, and that the bank issues, even just the fear in banks of banks right now, not that there should be much, but just that fear alone is something that they can monitor, as they think that will slow the economy, which is what the Fed wants to do. So in my mind, in our mind, and we've been talking about this, the Fed hikes are becoming not so useful, not as impactful as they should have been, simply because it's really only impacting housing primarily, and lending rates, right?
Yeah.
Most corporations, most big businesses who needed to borrow money, they've already borrowed it in years where interest rates were close to zero. So the normal movement higher in interest rates isn't having the same impact, because most big businesses, if not all big businesses, any major capital requirements that they needed, they pre-financed, right? So they locked in rates. Apple borrowed money close to zero 3 years ago, 4 years ago, 5 years ago, and they borrowed it for 10 and 20 years. So, which is very different than, if you get out of the 2000s, you go back into the 90s, when companies need capital, they tend to get it as they need it. Over the past 5 or 6 years, because we had zero rates, companies who needed capital got it when it was at zero, and companies who thought they might need capital in the future got it ahead of time when rates were at zero, knowing that they probably wouldn't see zero interest rates again.
Yeah.
Therefore, the parts of the economy that are sensitive to rising interest rates went from, in a normal rate environment, all parts of the economy, to now just really housing. Mm-hmm. Does that make sense?
Yeah.
So and the Fed sees this, which is why they actually have come up to 5%. I think they're even shocked that it hasn't had an enormous impact on slowing the economy, therefore bringing inflation down, so on and so forth. I think the Fed is going to ride this banking fear situation out. I think the banking fear situation will do the job that the Fed that thought they were going to be able to do. Does that make sense?
Yeah.
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 Again, we revised this chart to also impact, to reflect earnings. We're going to find out later this month. And last month we talked about, will earnings hang in there? We were talking about the first quarter earnings, January, February, March, which get reported in April, May, and June. So we're in April now. and we're going to find out how good or bad earnings were. But projections going out 9 months, 18 months actually look quite strong. That might be something the market's paying attention to. And then we threw in a debt ceiling chart for you. We put together a debt ceiling video, which we haven't released yet. We'll release it shortly, but we stole one of our charts from that presentation that we'll throw in at the end of this presentation. So
great. If I can circle back to your comment about the Fed not being as impactful, because we know how impactful they have been with their actions in both the stock and the bond market. It's amazing to me. We're going to transition here to what's been going on with the markets recently. Despite all this uncertainty that continues, we have seen a rally in the markets.
We have, yeah, and this chart reflects the October lows. It was October 13th was the low of the markets, which we think will hold, actually. And you see here, we've measured the S&P 500, and to explain to the listeners, that's the broad market. You have a combination of technology companies, healthcare, utilities, energy, financials. We also charted out the NASDAQ, which is very heavy technology and healthcare. And then we also included the Russell 3000. We'll refer to that as the total market. So that's not just large cap, big companies, that's large, mid, and small companies. So the 3,000 largest companies, right? So with that, it's not just Apple and Amazon, it's very small companies included. And what you see here is the NASDAQ has actually entered a bull market. And to define entered a bull market, right, that is a move in price that is 20% above its low. Mm-hmm. Again, the low being October 13th, it has now gone up about 23% since that October low. And that, ladies and gentlemen, is a bull market for you. Now, I take this one with a grain of salt because it's the NASDAQ. The NASDAQ is very concentrated. The weight of Apple, Amazon, Nvidia, Microsoft, Facebook, which is now called Meta, is about 50% of the NASDAQ, right? It's the S&P 500, but only viewing the growth portion of it. View it that way. So it's a very narrow view of the market, very overweight technology.
And I think viewers may recall, if they go back to our videos from 2022, these were the areas that were the most hit last year.
Exactly. So the sectors and companies that got hurt the most, generally speaking, have recovered the most so far. Mm-hmm. So yeah, you see the NASDAQ here entered a bull market. We put that cute little bull there to reflect that. But then the S&P 500 hasn't yet, which is the broad market. And even more specifically, a broader indication, the Russell 3000, hasn't yet. But they're only about 5% away. And in our January video looking out, for the year, our 23 forecast, we had mentioned that a bull market will begin sometime this year, probably the second half. We hope it's the second half, meaning we would like to see more of a gradual increase.
Sure.
Rather than a snapback, because that is something that probably won't stick. Mm-hmm. But we're on the verge of entering a bull market, and again, it could come. It could come in April, potentially May. I'm thinking we'll be there by the end of the year.
Okay.
You can see we're not far away. One of the indexes is already in a bull market, the NASDAQ, the S&P, and the Russell 3000.
Okay.
Both very broad indices are not too far behind, but they are behind.
And I think many listening may be surprised to hear that we have come as far as we have since October. Because certainly when we watch the markets on a day-to-day basis, it has certainly not gone in a straight line. You can see all three indices here have not gone in a straight line.
That's right. Yeah. And Julina, absolutely. I think if you're a listener, you're a client, you're saying, well, wait a second, inflation is still high. It's lower than it was, but it's still high. Okay. The Fed has increased a couple of times since October, actually a few times. Earnings haven't improved. They haven't gotten any worse, but they haven't improved over the past quarter and a half or so, maybe 2 quarters. Seems like headline risk is increasing. There's a lot going on, yet the market has rallied. Right.
Yeah.
So the market looks ahead somewhere between 3 and 9 months. And there are some inflection points and some pivots going on, or that we will be seeing in the next 3 to 9 months that the market is already pricing in. So the market is future looking. Economic data and reports are backwards looking, if that makes sense. I'm through my lens, the market is likely pricing in the Fed having to cut rates. It's caring less about, and it's becoming less sensitive to these quarter point increases. It is now looking beyond the trees saying, great Fed, the higher you go, the more you'll have to cut and the sooner you'll have to cut. The bond market, which we don't have up here, is also pricing in the Fed cutting rates.
Correct.
So the stock market is looking at the bond market saying, you know something, and we're going to believe you now, not the Fed.
Yeah.
Number one. Number two, valuations. PE ratios for stocks for the market are no longer significantly elevated. They're closer to fair value. So the market is not expensive. Earnings forecasts have been downgraded for this year and next year, but they're still pointing up, which is good. So you can have earnings growth on top of, if you measure over the next 24 months, on top of fairly priced stocks instead of stocks that are expensive at this point. Rates decreasing, inflation that's coming down, guaranteed. And there's another indicator. The US dollar has weakened. So therefore, the rest of the world, if they're to consume US goods and services with their foreign currency, the US just became much cheaper to consume for foreign investment. So that's a great catalyst for growth.
Yes.
So you have this recipe for a bull market that's starting to get thrown into this pot, and you could see the formation of a bull market coming.
Sure.
And the market is becoming much more sensitive to that.
Yeah.
Less sensitive to the Fed, because the market doesn't wait for the official signal from the Fed or from inflation to hit a certain point. Once it gets to a certain direction, it's now looking beyond the trees. Now it's looking forward.
Yes. And I think that, is it fair to say, I'm going to give the conclusion now, and we're going to dive into this. But when we look forward 1 year to a 5-year time horizon, lower inflation, lower interest rates, cheaper valuations, and higher earnings all tend to be drivers of a bull market.
Yeah. Forget about us talking about the current setup.
Sure.
When you identify the traits of a bull market, everything you just said is what a bull market is all about.
Sure. And I'm just summarizing what you just said.
Yeah, right. Exactly. So on top of the weaker dollar, which is good for U.S. investment.
Yes.
If you're using dollars.
And don't forget the icing on the cake, which is how we feel, our sentiment.
You're absolutely right. So sentiment, how we feel about things. Bull markets begin when sentiment is low. It's a contrarian indicator. It's a phenomenal contrarian indicator. It's a very accurate contrarian indicator. So the ingredients are good. The emotions are bad. That is where a bull market begins. And where there, it's coming soon. You can look back to October, when we had the lowest sentiment reading, consumer sentiment and business sentiment readings in history. Yeah. So it's very likely over the next couple of months, we will be saying the following. Hey, everybody, remember the bull market that we were talking about potentially entering soon? We entered it, but I have news for you. It started in October.
Yes.
A bull market is a move of 20% from its low, measured to its low point. And if the low point is October 13th, to be specific, the bull market began already. It began in October.
Exactly. And I think the last thing maybe worth mentioning before we transition into more detail is the fact that bull markets don't always align with recessions and economic conditions. And I say that because there are so many that are still concerned that we are entering a recession. That doesn't necessarily mean that it's bad for the market.
Yeah, you're absolutely right. So the economy, employment, manufacturing, services, all those indicators, very different than the stock market, corporate earnings, right? The stock market, bull and bear markets. The economy, recession or expansion. That's it. The two very different things. The economy, the way you gauge the economy is using stale, backwards looking data. And the way you gauge the stock market is, looking at the actual price direction, underlying equity fundamentals, corporate fundamentals, trend lines, and price action.
Right.
That's a lot of that is forward-looking stuff.
Yeah. No, thank you for going through that. And I think that's a great segue to talk about why we have seen this recent activity, as you had talked about before. If we can start with the Fed.
Sure. So again, one of the many ingredients, drivers to the stock market moving in the right direction up, at least so far this year, is the Fed itself giving guidance into 2024, 2025, and 2026, saying, hey, rates are high now, but they're going to be lower in 24, 25, and 26. Great. Well, we're getting closer to 24, 25, and 26. And you can see here on this chart, the dots, the gray dots and the blue dots. The gray dots are the Fed voting members and where they are voting, where they think interest rates will be. The blue dot is the consensus of the Fed, and the blue line is the market. Generally speaking, the market is right more often than the Fed. And the stock market is saying, hey, rates are coming down. And you can see if you squint that rates are coming down in 23 and in 24 and in 25 and in 26. So there is the probably one of the main ingredients for a bull market.
Right. Rates
normalizing, in this case, coming down.
I've been squinting so much I had to get glasses. This is it's
So,
amazing to watch.
Yeah, and again, we've talked a lot for the listeners about room temperature interest rates, right? Neutral rates. Neutral rate is still defined as about 2.5%. That's room temperature interest rates, and right now we're twice that. Correct. So if you really think about it, to have fun with percentages, the Fed will need to cut interest rates in half or by 50%. That's a significant amount of cutting that has to happen to get to neutral. They're going to try to chop up those cuts into quarter point increments and to hand them to the market and the economy slowly over time. In a
slower fashion, yeah.
Yeah, we think they're going to have to get go a little heavier up front. And then they can spread out those quarter point chips over time. And that's a very good thing.
Yeah.
That will the stock market and bond market will.
As a reminder, that is great for the price of bonds.
Great for the price of bonds. Great for the price of stocks.
Yeah, absolutely. And I think that most of us are aware of the recent banking issues and the fact that there's a lot of conversation in the media about the fact that the Fed has to pivot based on what's occurred. If you can share your opinion about this.
Yes. So
I was trying not to laugh before we did this webinar and when I saw this slide, but sorry, we're there.
Yeah. Well, I think there's not enough discussion around this chart here. So we're going to discuss it for everybody to make you understand what's going on with banks. So the Federal Reserve, in their quest to slow the economy and to normalize economic activity, they thought it was wise to increase the cost of money. And they do that through increasing interest rates. If you need to buy a house and finance it, gone are the days of 2.5%. Here are the days of 7% mortgage rates, right? That slows the economy. It slows down economic activity to a degree. Just conceptually, this is how it works. But while they were so focused on carefully, cautiously crafting their words to, give signals that rates are going to go up and inflation is our main focus, and once we're done focusing on that, employment is our next focus, they forgot about something that they're responsible for. Banks.
Right.
Safety of banks. So I think this was the big miss for the Fed. It's the Fed that created the potential bank issues that you're hearing about. Because if you have money sitting at a bank, it yields probably less than 0.1%. But according to the nationwide average, according to the Fed's own data, the average deposit rate at a bank, when you mix money market bank accounts with savings bank accounts with checking bank accounts, is 0.38.
Correct. Yeah.
But short-term treasury bills and bonds and money market mutual funds that invest in short-term treasury bills and bonds, which are guaranteed, mind you, with no limit, yield north of 4.5%.
Yeah.
So why would you have excess cash in a bank yielding close to zero when you can get close to 5% interest rates?
Massive
right?
difference.
Yeah. And look, at the end of the day, have under the FDIC limit, under 250 sitting in a bank in your rainy day fund. But if you move money to us, we use Fidelity Investments as our custodian. We put client cash in the government money market. It yields north of 4.5%. It's fully liquid. It's the only guaranteed investment in the world we can talk about. That's U.S. Treasury securities. And you make about 100 times the interest.
Yeah.
So we talk about this because, is there risk at the banks? Well, not really. The banks that failed, a Silicon Valley Bank, they had poor risk controls. They had, taken client deposits, and instead of splitting them short-term versus long-term bonds, they put most of that stuff in long-term bonds.
Yeah.
At the same time, they had a lot of money being withdrawn from their clients.
Yep.
So they didn't have a short-term fund to tap into.
They bucketed it wrong.
Yeah, Signature Bank, which is another small bank that catered to the cryptocurrency crowd in New York, that went under as well. So those were two very unique banks that just did not know how to allocate capital. The vast majority of the banks in this country do know how to do this. And there's really no issues at those banks. However, banks make money off of your deposits. So they're paying you, the depositor, less than 0.5%, and in most cases, less than 0.1%.
Yeah.
They are making the 4.75% because they take your money and they can hand it to the Fed and receive interest from the Fed.
Yeah.
Okay. Yeah. But they can only do that if your deposits are at the bank. So I think there's going to be not a bank run, but more of a bank walk where money is going to slowly trickle out of banks, not because of the safety of banks, more so because you can get a real yield, a really good yield in the stuff that backs up the banks, FDIC, and the government, treasury bills.
Shift in demand.
Absolutely.
Yeah.
So I think the Fed having overnight rates at just about 5%, just under, is creating a deposit flight risk for banks. If banks don't have your deposits, they can't lend money out.
Right.
If banks don't have your deposits, they can't make a spread.
Yeah.
If banks don't know if they're going to have your deposit because government rates are too high, they're going to be very hesitant to lend out a lot of money. Does that make sense?
Absolutely.
So the Fed, by having interest rates so high relative to what banks are paying, and I get it, they did this over a very short amount of time. They thought they checked all the boxes. They thought they checked their checklist. But there was one little thing that they missed. They might create deposit flight risk.
Yeah.
It doesn't really equal bank solvency risk, but I can see banks having less on deposit because there's an alternative, which is why I put the jaws of this alligator on the chart. In essence, saying the wider the spread gets, right, the more dangerous it becomes.
Right.
So hence this chart illustrates it well.
And thanks for clarifying it was an alligator. I didn't know if it was a crocodile, but the other question I have for you is it fair to assume that the spread is the widest we've ever seen?
The spread between the average bank deposit rate and what you, the investor, can get through short-term treasuries or a money market fund that's invested in treasuries is the widest in history.
Amazing.
So if the Fed wants to help the banks,
right,
then they will bring rates down. So the jaws, the spread between bank deposit rates and short-term treasury rates will close.
Okay. Well, I hope we see our alligator in a milder form next time. So we'll see.
I think that alligator's mouth will be shut a little bit more.
Yeah. Okay. So I think the question that comes up a lot when we talk about banks lately is what are the implications with small banks? And if we could talk a little bit about that.
Yeah. So on the next chart, small and mid-sized banks are really the lenders to businesses, right? They issue small business loans, but more specifically, they're known for small business or commercial mortgages. When a bank underwrites a mortgage, a traditional residential mortgage, typically the underwriting is done according to government standards. Government standards will be, I'll just throw out some names, Fannie Mae, Freddie Mac, Federal Home Loan. Assuming the bank, let's take your local bank. I'm just creating a name here. This is not a recommendation. Let's just say it's Webster Bank. Webster Bank will underwrite a mortgage according to government guidelines. If they do that, then they can take that mortgage once it's closed and get the money back from the government.
Yeah.
That makes sense?
Yeah.
Okay, so that's easy stuff to do. However, commercial loans, personal loans that aren't residential, and commercial mortgages are primarily held, those loans are held by those small banks and mid-sized banks. Small and mid-sized banks account for just under 70% of all commercial real estate loans. I mean, that's a fascinating statistic.
Yeah.
It's generally always been around there. So you can see the importance of small and mid-sized banks. But Julina, we just talked about the fact that there might be some deposit risk because the Fed has interest rates way too high.
Sure.
Relative to what banks can actually pay on those deposits, right?
Yeah.
So if these banks have deposits coming out for the sheer fact that those deposits can find a yield significantly higher,
yeah,
without taking on any risk, that means that these small and mid-sized banks won't be able to lend out as much.
Absolutely.
After all, our deposits at banks are used as leverage to issue loans.
Yeah.
So we can see a scenario where banks in general, mostly small and mid-sized banks, might be a little bit more cautious around lending money to businesses and individuals, because they don't know what their deposit base is going to look like.
Exactly.
That makes sense?
It does. And
Okay.
and you're talking a lot about deposits and flow of money. And I know you have a comment around that as well.
Yeah. And just to show you what's going on behind the scenes, this is a chart of deposits, actual deposits at small banks versus large banks. So 2 weeks ago, when all this banking stuff started to hit the news, the banking issue started to hit the news, you had this massive withdrawal from small banks. And you had this massive inflow into large banks. And what you can see there is, you naturally, I think when people are afraid or uncertain around what's happening with the banks, you tend to run towards those small banks to pull your money out of. I don't know if they're going to be okay. They don't communicate effectively, efficiently. The data is hidden.
Mm-hmm.
So those small banks, they might not even be publicly traded, so they don't have to disclose a lot of this stuff. And then you run towards like a JP Morgan, right? Or a Wells Fargo or something like that. And that's exactly what happened.
Yeah.
A lot of deposits came out of small banks and they went into large banks. That has now stopped, but it happened.
Sure.
Right? There's not much more of it happening.
Yeah.
But what happened has happened. There's a lot less money in small banks and a lot more money at large banks.
Yeah.
The next slide will paint another picture.
Yeah, I was going to say we have another flow slide, which is also equally interesting in its impact.
But all banks glued together, large and small,
mm-hmm.
and everything in between, they had net outflows of deposits of just under $900 billion.
Right.
Mm-hmm. Let's just call it just under $1 trillion since the Fed started hiking interest rates. But money market funds have had an inflow of about $600 billion. And that is the flight of cash seeking yield.
Correct. And they converged.
Money coming out of banks where maybe you're making pennies of interest, if you're even making pennies of interest, seeking higher yields.
And Bob, where do you think the rest of that money went? The stock market?
I think the difference between the 862 billion and the 577, what's not measured here is direct flow into short-term treasury bonds and bills, which is something that we at the firm have been buying for clients as well.
Yeah.
There's probably, I could see, $300 billion nationwide, looking at short-term bills and bonds, even short-term tax-free bonds as well. Yeah. That's where the delta went.
Sure. Another conservative option.
Absolutely. Yep. So you can see that this is an issue. You have money market funds rising in assets, bank deposits declining. Well, if bank deposits decline, don't expect banks to lend freely or in a cheap, efficient manner going forward.
Sure.
The Fed's going to have to cut rates. And this is our subtle narrative to say, hey, Fed, you might want to wake up because your rate increases are becoming significantly less effective. It's starting to hurt the banks. And if banks aren't lending, then that is a sure way to slow the economy. Yeah. Every sector, every industry, every individual. It's not just one industry. It's not just high net worth, low net worth. This impacts everybody. So the Fed's got some work to do. And the work that they have to do is they better change their narrative and start cutting. And this is why we warned probably over the past 6 months at this point that the Fed should pause rather than continuing to hike rates because they're going to break something. And we think the Fed broke the banks back, in essence, to say it that way. And they've brought on some bank risk that they really shouldn't have. It's
Sure.
going to be okay, but the Fed's going to have to do something about it. And what they're going to have to do is cut interest rates.
And I think if the Fed isn't paying attention to this slide, we are fairly confident they're paying attention to the next one.
Let's hope. So the money supply, how much money exists in our economy?
Mm-hmm.
That's this chart. You can see that, it hovers around, this chart of money supply hovers around 0 to 14%. Sometimes when we create a lot of money, it's because there's an emergency. Sometimes when we shrink the money supply, it's to either slow the economy intentionally or it slowed itself. And you can see all of a sudden this major outlier in 2021 was this massive creation of dollars and the injection of that money into the economy, right? So trillions upon trillions of dollars just got thrown at the economy.
Right.
We increased unemployment benefits. We handed money to businesses for various reasons. We gave money to states. Money was being handed out left and right, and it was way too much, which really drove inflation.
Sure.
Now you can see that massive increase of the money supply has turned into a massive decrease of money supply. So that means, generally speaking, that there's less money available. There's no creation of it. There's actually a removal of it. And the Fed is in control of that, and the Treasury. The Federal Reserve has been the biggest buyer of its own bonds probably for the past 15 years or so.
Yeah.
And while they were doing that, they were also creating new bonds, therefore new money, just to keep things liquid.
Mm-hmm.
Okay? Now the Fed is no longer buying their own bonds. They're letting them mature, and they're not creating new ones. So therefore,
unwinding.
That's called quantitative tightening.
Mm-hmm.
So we have this unique scenario for the first time in history that the money supply has gone negative. Now it's a relative chart, not absolute, but you can see that there's really just less money out there, which needed to happen, but it's become quite extreme, which also helps us with our high conviction statement of inflation is coming down. Just wait and see.
Yeah, I was going to mention, Bob, you alluded to the correlation of inflation rising when the M2 supply peaked. The assumption then is historically the correlation when the money supply decreases to inflation is.
That is a correct statement.
Yeah. Okay.
That is right.
Thank you for just clarifying that.
Sure.
And
high prices are one thing. When people aren't paying high prices, trust me, you don't have high prices for long.
Yeah.
Prices come down.
Yeah.
Very quickly.
Yeah.
Very quickly.
And I think I feel like we have beaten the inflation topic over everyone's head, but we do have another slide in here. It's especially relevant given some of what we've seen come out from the Fed in the past week, if you can go through it.
Inflation will continue to come down like it has for the past 9 months, sharply. We might have one of the biggest declines in month-over-month inflation. I'm sorry, year-over-year inflation coming in April.
Okay.
We'll find out next week. I think it's on the 12th.
And can you talk a little bit about why?
Sure. The March report, which is going to be released in April. Last March, the monthly inflation number was sky high.
Mm-hmm.
Sky high. It was one of the highest we've had. I think the second highest we've had in 20 years. That is going to roll off, and the new March number is going to roll on. And I think the spread between those numbers is almost a full point. So it's very likely inflation goes from about 6 to maybe just above 5 or
Okay.
5. I mean, in 1 month, that's an enormous decline.
It would be one of the most aggressive declines that we've seen.
Absolutely. Which goes back to us saying inflation is not going to be the issue that we all think it's going to be. Inflation is being tamed with time.
Mhm.
That's it. As time rolls on and the new inflation data rolls in, the old hot inflation data rolls off.
Yeah.
So here's a chart we use this blue arrow to indicate if month over month for the next 10 months, we get 0.3 increases month over month, right?
Yeah.
Which are slightly above average months, then inflation will hit the 2s by June and July.
Here.
Yep.
Yeah.
And that is just taking the new 0.3, making the assumption that 0.3s roll on and having the old data roll off. You'll have, inflation in the 2s and 3s. Period. This is without, I should remind people, this is without the housing data that doesn't get updated too often. That's included in inflation. I say this because the housing data that the government is reviewing is still showing a slight upward arc. But the
Yes.
live housing data is showing a sharp downward arc. That hasn't synced up yet. And
No.
that is 1/3 of it, the inflation data.
Yep. Which could continue the impact.
Which I believe is going to cool inflation even more towards the end of the year.
Okay. Okay.
Great.
Great.
We're happy to chat about that if anyone has any questions. And we can show you mountains of data to back it up, which is why we've had so much conviction now for the past almost a year, saying that you have to look beyond peak inflation. It's coming down and it's coming down fast. And we have been.
Absolutely. Okay. No, thank you for going through that. And I
And
think
if you don't believe us, here's a chart.
Yeah.
Here's a chart going back to, I believe, July. So we had Kyle in our office put a ice blue arrow to indicate the path of inflation.
Yeah.
We just want everyone to pay attention to that.
Okay. No, that's great. And I think
even more.
Yeah.
Here is a measure of commodities since June 1st. On the right-hand side, you'll see that every one of them is below 0. So therefore, that's a decline.
Yep.
Natural gas is down 75.
This is natural gas. Yep.
Down 75.44%.
Yeah.
But all the others that we look at, coffee, lumber, gasoline, crude oil, Brent, wheat, copper, cotton, soybeans, nickel, corn, natural gas, they're all negative. They've all come down.
Can I just remind people that with all of the volatility that we saw last year in the stock and bond market, there was a lot of questions around, well, should we be looking at commodities? And here it is just several months later.
Yeah, commodities looked good for about 72 days.
Yeah.
And then they have looked horrendous ever since.
Yeah.
Yeah. Commodities really are playing with fire. It's amazing.
Okay.
And we say that because commodities end up being the input cost to inflation, right? Yeah. Those are the raw materials needed. And the price of raw materials has plummeted.
Yeah.
You might not see that yet at the grocery store, the hardware store, so on and so forth, because many of the items were purchased at higher prices. So, if you think of the local hardware store, they're not going to sell you cheap lumber until they sell all of their expensive lumber.
Exactly.
Or high prices.
Yeah.
Then they will average the price down.
But from that perspective, some opportunity going forward there.
Absolutely.
So, yeah. Okay. Great. We also talked about earnings last month. If we can give a quick update there.
Sure. So that was a long-winded explanation of the Fed and why they have to bring interest rates down and why inflation is going to come down. Yeah. And why any of their conversations around inflation is really just filler. It's nonsense. They should stop talking about employment as well and they should focus on liquidity and banks and making sure there's not a lot of deposit risk. That's
Okay.
what we think they should be talking about. So
Okay.
that data backs it up.
Yeah.
The other topic, earnings. Yeah, so earnings came in over the past year barely below the prior year, and they were good the prior year. So they came in barely below, which was
Here.
bizarre because you had a significant decline in the stock market, but
Yeah.
earnings kind of hung in there. We've talked about this ad nauseum at this point.
Right.
You can see it on this chart, but you can also see future earnings expectations, which have been knocked down.
Here.
The
Those are the blue.
blue lines, which
Yeah.
are, 23, 24, and 25 earnings, look to be higher than last year. 25 looks to be higher than 24, and so on and so forth. So you can see just how earnings move
Mm-hmm.
up and to the right, which is a very, very good chart. So,
Yeah.
the market starts to price in the future once it senses that the bad news is in sight. It doesn't wait for it. It now looks to the future, and the future looks a lot brighter.
Yeah.
Which
And,
is
and,
some short-term positive movement in the market.
and again, this is a driver of longer term stock market return.
It is the driver of the stock market. So when all the nonsense cools down and the
Yeah.
market really falls back on its fundamentals, it is the compounding earnings power of the companies that make up the stock market
Okay.
that drives long-term shareholder value in price return.
Yeah.
Period. End of story.
Okay, great. And I think the last thing we wanted to quickly mention, had we not had a lot of discussion around the banking system, we would be paying a lot more attention in the media to the debt ceiling, and there's more to come. And as you mentioned, we have a webinar around it, but we should certainly at least address it.
Yes, we'll give you one slide. People were making comparisons to 2011 with the debt ceiling and how it created a lot of market volatility during the summer of 2011. What they're not mentioning is in 2011, we also had the Eurozone debt crisis. Anyways, that's, so we did a comparison. The way government was made up, the way the House of Representatives was made up in 2011, very different than today. 2011, you had the results of the midterm in 2010. That was really your red wave, right? Republicans flipped 64 seats in the House of Representatives. That was the red wave. That was massive. And it created a House of Representatives that was deeply Republican. And even if they lost a bunch of Republicans, they would still have this strong majority to, stand firm and get what they wanted. Fast forward to today, and we all know that the midterms, it certainly divided government, but barely. So the House of Representatives there's a narrow margin in the House of Representatives. And if just a handful of Republicans side with Democrats when it comes to the debt ceiling, then you just have a bunch of nonsense and news articles, right? There's probably not a lot that's going to happen around the debt ceiling.
Okay.
I think you will have a resolution to the debt ceiling quite easily, but that doesn't mean the soap opera and the drama won't happen.
Yeah.
Right.
More noise to come.
Yeah. I think in 2011, Obama at the time, he had to cut expenses. He had to budge. He had to blink because the House was not going to. Even if the House lost 20 Republicans, they would still have a heavy hand in the negotiations. Today, Republicans can't lose many Republicans because it's really a narrow majority that they have. So again, don't worry, the media will turn this thing upside down, inside and out, to make headlines, to make you feel terrible. You are going to have both sides negotiating like they both have tons of leverage. But there will be a deal that gets done, just like every other time in the history of the United States. We don't think this time will be any different.
Okay, great.
No.
Great. Thank you for that. I think then, if I can try and summarize everything that we just went through again, which is really just a continuation of March, is just that, number one, maybe we're not as obsessed around the Fed as we were before. The markets seem to be telling us something different. We continue to see positive growth in earnings, maybe just a little bit more subdued. And then this whole debt ceiling debate, I like to remind people we've been here 100 times. And unfortunately it will continue, but it's something we have to address in the short term.
That's right. That's right. The bond bull market has begun. We mentioned that in the past, and the stock market bull market is right behind it.
Okay.
We illustrated that to you, and it looks like it will get better towards the end of the year. It might even get better sooner. So we shall see, and we'll certainly keep you posted.
For sure. We will be back for an update in May. And as you mentioned, we will have our debt ceiling webinar as well. But certainly if anyone has any questions or concerns, they can reach out to any of us here at Principal Wealth Partners, and we're happy to have a conversation around it. So thank you, Bob, again for your insight, and looking forward to the conversation next month, and we'll see if the alligator's back.
Absolutely.